and welcome to Cents and Sensibility, the Inflation Guy podcast. I am Mike Ashton. I'm the Inflation Guy, and I'm your host today. And today we're going to talk about the why behind the slide. Stock market has now been sliding for a couple of weeks, and the pace of the decline picked up today. I think kind of scared a bunch of people overnight. In Japan, we got double-digit declines in their market, the worst one-day decline in the Nikkei since 1987. So there's some angst, some concern, and we're going to talk about the why behind that slide and what it means, if anything, for inflation. But before we get started, I want to thank our sponsor. I talked last week about some of their products, and our sponsor is Simplify, and I'll read their spot in a second. And one of the things I mentioned, I think I said last week, the last podcast, which was a little bit more than a week ago, I mentioned SPD, which is one of their ETFs, and I mentioned some other ETFs that essentially embed optionality to protect against sharp market declines. And I mentioned that those aren't necessarily long-term holds because you have to pay option premium. There are times when they are really good. And this happens to be one of those times. As I'm doing this podcast, as I'm recording this, SPD is up on the day while the S&P 500 is down 3.3%. So, that's again, you can go back and listen to the last podcast where one of the main takeaways was you want to be long volatility. Volatility was very, very cheap. And with all the potential things that could have gone wrong or could go wrong, it seemed like being long volatility was the right thing to do. And so some of the products that I talked about are doing quite well. So worth listening to that. This episode of Cents and Sensibility is sponsored by Simplify ETFs, a fast-growing manager of liquid alternative ETFs. Simplify is bringing Wall Street to Main Street by providing access to institutional strategies perfect for diversifying your equity and bond portfolios, previously only available to big institutions and the ultra-rich. Check out their website at simplify.us. That's simplify.us, and you can find their entire lineup of ETFs at simplify.us/ETFs. So, as I said, the Japanese stock market had a really bad day. And as I record this, the U.S. market's having a pretty bad day. It's early yet. We tend to get bounces on this sort of day or right after this sort of day. But there's lots of history of having those bounces turning to tears too. So the first thing to say, anyone who's been in the market long enough and seen, the 87 crash and the 2008 crash and long-term capital and all these things, the first thing to say is, for gosh sake, don't panic. The market is less than 10% off of its all-time highs. The equal weight index, okay, so that's the S&P 500, less than 10% off its all-time highs. The equal weight S&P, where each of the elements gets an equal weight instead of being capitalization weighted, which biases action towards the largest stocks like NVIDIA, the equal weight index hit its all-time high last Thursday. It's less than 4% off of its all-time highs. So, 6% off its all-time highs. But it's, people get very, when the market has done nothing but go up for a long period of time, people tend to get very antsy by fairly small sell-offs. Right now, this is mostly a large cap phenomenon. As it extends, it won't be just a large cap phenomenon, but it was the large caps that were the most overvalued, and so they will lead us on the way down. Not only should you not panic, because this is, again, it's a large cap phenomenon mostly, and it's not an enormous percentage. But for some of you listeners, down is good. If you are young, I say this periodically, if you are young, you want bear markets. You want stocks to be down. And the reason is because if you're young, if you're in your 20s, early 30s, you're going to be investing for many, 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 many years. And you're going to put much more money into the market than you currently have in the market. And therefore, you would rather be buying those stocks at lower prices, not higher prices. So you should want sell-offs. It doesn't look good on your current portfolio, but there's this shadow portfolio you have, all the stocks you haven't bought yet, but you will. And those are going down in price. Okay, so that's sort of the way to think about it. If you're middle-aged, sell-offs like this are meh. You've got a portfolio that's big enough to matter, but you're also still buying a lot of stuff in the future. And so you probably shouldn't worry too much about it. A decline in your returns today increases your expected returns over the next 10 years. So it's probably not that big a deal. If you're in retirement, then market sell-off and you're taking money out. You're starting to liquidate your portfolio in your golden years. Then sell-offs are obviously bad because you're now selling that portfolio at lower prices. But that's the reason why, if you're in retirement, you presumably have already adjusted your risk down to the so-called sleeping point. And so, when you get a sell-off like this, you look at your portfolio and you're like, okay, that doesn't really change anything about my future. Now, if you're 75 years old and you had all your money in NVIDIA, then, well, yeah, I don't know what to tell you. But then you're probably really upset today, and you probably should be. Now, if this is the start of a bear market, it's been a long time since we've had a bear market, then stocks could go lots further down. Okay, 10%, some people call 10% a correction and 20% is a bear market. And that's obviously that number depends on a whole bunch of, the significance of 20% depends on whether you're looking at a really high volatility index or a really low volatility index, the significance of what a 20% sell-off is. But if we're going to have a bear market, then we're obviously going to be down at least 20%, probably 30%, probably 40%. Okay, so the bear market can take quite a bit off of equity market valuations, especially when those equity market valuations are very, very high to begin with. But that's okay. Bear markets happen. That's part of the market. If you're a trader, okay, you're in and out of the market, and you were long going into this, and not long vol at the really cheap levels, as I'd sort of mentioned, then days like this suck, and bear markets suck. If you're an investor, then declines today mean better long-term possibilities tomorrow. Buffett, and I guess there are other value investors who caution you to think about the market and think about when you're buying equities as an owner of the company. If you own Coca-Cola, it's worth no less today than it was yesterday. Same with NVIDIA. It's worth no less today than it was yesterday. The market says it's worth less, but if you owned the company instead of owning public shares in the company, and you went into the board meeting and they reported the current prospects, nothing about those prospects has changed. Okay, there's nothing fundamental about the business that has changed. And so that's the way that, even though you're investing through a public issue of securities where Mr. Market tells you the price changes every day, you should work really hard to recognize that you're invested in a particular company because you believe that the particular company, the prospects. You're invested in equities generally. You're invested in the market because you believe in the long-term prospects of the United States. That doesn't mean you want to put all your money in when the price for those prospects is really, really high. Entry level does matter. But it's important to sort of keep in mind, be level-headed about what it is that's happening and that it's a price phenomenon and not necessarily a value phenomenon. Now, to be sure, near-term prospects have changed a little recently, but 2 weeks ago, everybody was a long-term holder. When we were up at the highs, everybody was a long-term holder of stocks and buy the dip and all that stuff. Since that time, because of Iran's support of two terrorist groups that it feels duty-bound to defend, an attack from Iran on Israel is almost assured. in response to Israel's taking out of the leaders of a leader or two of Hamas and Hezbollah. And so Iran's going to respond, and it's potentially going to be a bad response, and probably Israel doesn't respond to them, but maybe they do. I mean, we are closer than ever, closer than for many years, to a hot war in the Middle East, and that's definitely changed from 2 weeks ago. On Friday, we also learned that the unemployment rate in the United States rose to 4.3%, which is now 0.9% off of the lows of the unemployment rate, over the last year. And that also triggered the Sahm rule, which is a decades-old rule that Claudia Sahm brazenly claimed was her idea. That basically says that once the unemployment rate starts to going up, it tends to keep going up. And it means that once you have some non-de minimis increase in the unemployment rate, it means you're probably in a recession. And so it's going to keep going up. Again, this is something that those of us who've been in the market for 30 or 40 years or whatever have mentioned lots of times. It's not Sam's rule, but, good marketing is important. And Claudia Sahm got some good marketing there. Anyway, that is new news. Friday's unemployment report was weaker. Employment report was weaker than had been expected. The unemployment rate went up more than people were expecting. And so that's a little change in the near-term prospects. And the political picture in the U.S. recently expanded from arrests of dissidents to include attempted assassinations. And so that's clearly a change in the tenor of our political discussion. And as I noted in the last podcast, and one of the reasons I said I want to be long volatility here is that I fully expected that investors would want to reduce the riskiness of their investing positions over the next couple of weeks and months, given what is likely to be a fraught U.S. election with riots no matter who appears to win, and probably nobody acknowledging defeat. Regardless of who wins, the other party is not going to acknowledge defeat for some time. So, that's in that kind of environment, heading into that kind of environment and ignoring the Iran thing, ignoring the recession thing, just heading into the political environment, I fully expected investors to want to take some chips off the table and reduce risk. Well, if that's going to happen, then you were going to see the market sell off. But they're near-term things. The bigger problem with the equity market was that only good things were priced in. And so we were trading at levels which were frothy, to be generous. But to be fair, they've been frothy for a long time. So there was nothing that sort of said going into last week, oh gosh, the stock market's about to correct, 10, 20, whatever percent. It's important to remember that the stock market is not the economy. And so when we have a recession, it doesn't mean that the stock market necessarily goes down. It tends to go down in advance of a recession. But it isn't the economy. When you see the stock market drop 10%, it doesn't mean suddenly we're going into recession. A 10% decline in large cap stocks, especially from a position of being much more overvalued than 10%, indicates nothing about the economy at large. But when you get these sorts of risk-off trades, risks are correlated. And so oil prices have also been going down, right, since the stock market high, despite the prospects of a hot war in the Middle East. So since the S&P crested on July 16th, September crude oil futures are down also about 10%. So, despite the fact that we're about to have a hot war in the Middle East, because stocks go down, oil's also going down. And it's not much more complex than that, I don't think. So the risk sell-off is triggering the energy sell-off despite geopolitical events that would ordinarily provoke higher prices. And the energy sell-off in turn, now we're going to bring it back to inflation, is causing near-term inflation outcomes to be better because gasoline is a major driver of near-term inflation. And so when near-term gasoline futures prices go down, it means lower prices at the pump. Lower prices at the pump means lower prices in CPI for energy, and lower prices in CPI for energy, since energy is so volatile, means you're going to get lower headline prints. Right now, the market for headline inflation is pricing in a couple of 0.1% month-on-month headline inflation numbers over the next couple of months. That doesn't really affect core, but the headline numbers will probably be fairly agreeable. And if retail gasoline follows what the futures are doing, then you could even potentially get something better than that. But what hasn't changed in the last week or two are the prospects for inflation over the next 10 years. Nothing has changed about the next 10-year outlook, and yet 10-year inflation break-evens this morning had collapsed down to 1.94%. On Wednesday, they were at 2.25%. Okay, so it seems that all the Fed needed was a mild stock market setback, and voila, inflation is at target. Okay, 30 basis point decline in 10-year inflation expectations. Okay, that's crazy. Nothing that has happened should change your view of 10-year inflation outcomes that much. But long-dated break-evens always overreact to short-run movements in energy, short-run movements generally, but especially in energy. It's inefficient. It's an opportunity for traders. It happens. Barclays, back when I worked at Barclays a long time ago, showed that by getting long tips in months before high carry, you could systematically win, because the market would this could turn into a bond math 101 discussion, but you shouldn't be able to systematically make money by buying before you're going to get a known return, right? Because the market should reflect that in the current price. You shouldn't be able to make money buying right before a dividend payment. And in fact, you can't, right? It's very hard to do that in stocks, buying right before a dividend payment and making a bunch of money off it, because everyone knows there's a dividend payment, and so that's in the price. And right after a dividend is paid, that particular stock drops in price to reflect that the dividend is no longer attached. Anyway, same thing in inflation. You shouldn't be able to buy inflation-linked bonds right before you get really good carry and make money, but Barclays showed, again, 20-something years ago, maybe this is no longer true, that you could systematically do that. The point being, markets are inefficient. The inflation-linked markets in particular are fairly inefficient. And so when you see a decline of these 10-year break-evens, that's mostly just inefficiency. Another way to say this is that 10-year TIPS yields now are higher relative to nominal yields than they were. Okay, that's what a declining break-even means. It means that if regular 10-year interest rates went down 20 basis points and 10-year TIPS rates went down 10 basis points, then the break-even would go down by 10. But what that really means is that your yield on the TIPS got better by 10 relative to nominals. Okay, so that's the other way to sort of think about it. So what happens in these risk-off periods is that people fly into nominal bonds as, for safety, into regular treasuries, and not into TIPS. TIPS are sort of regarded, especially when it gets, things get really crazy and risk-off. People somehow look at TIPS like they're risky. And they're actually less risky than nominals, but when you get these kind of corrections, they're actually good opportunities to buy inflation-linked bonds instead of nominal bonds. Our model has TIPS about 40 basis points cheap right now. In other words, the yields are 40 basis points higher than they should be given where 10-year nominal yields are. That's a lot, but again, this is an inefficient market, and sometimes TIPS get even cheaper than that. But it's been a while since they've been as cheap as that. But anyway, stock market declines, like we're seeing, don't affect inflation prospects. What does affect inflation prospects is money growth. And in recent years, volatility in money velocity coming out of the post-COVID period, coming out of COVID, that also had a lot to do with inflation, and we've talked a lot about that. But people get wound up in looking at the micro. Okay, so let's think about, let's suppose, all right, this stock market setback is indicating a recession. We've got more people out of work, and people will look at the micro and say, well, that's going to be disinflationary. All right, we see more people losing jobs, so upward pressure on wages slackens. That's true. So retail price inflation falls. That's false. Okay, so it is true that wages don't go up as fast when there are more unemployed. All right, they go up slower. But the connection between wages and inflation is, let's just say it's very loose. That's being generous. From the micro side, you see that fewer people are going to go out to dinner because recession is coming, rather than eating in. That's true. So restaurants lower prices. False. All right, because restaurants are driven by costs, right? And so, people stop moving into rapidly growing and more expensive regions, maybe, so rents fall. Nope, that doesn't happen. People don't swap into a new car as often. That's true. And so car prices fall. Also false. The problem is that in the micro, we always are focusing on demand. And so when economists look at recessions, they say, oh, well, gee, this is going to decrease demand, and therefore prices should fall. But supply is affected in recessions as well. Producers cut back shifts and they produce less. New construction of housing units slows down, and so on. And so if you look at any self-contained microeconomic system, you can figure out how total output falls in a recession, and price changes are indeterminate. It depends whether demand fell more than supply. Sometimes they go up, sometimes they go down, but it's indeterminate, just sort of looking at the supply and demand curves. But that's in a closed system. And when we look at a microeconomic system, like looking at what's happening to restaurants, right? You can come to some sort of conclusion based on what you think supply and demand are doing. The problem is that microeconomic systems are not self-contained like that. They exist in the context of the macro, where the amount of money in the system and the velocity of that money moves the tide of the price level. And that tide is what that little self-contained unit, the restaurant market, floats on the tide of money and velocity. And so just because we're heading into a recession, I do believe we're heading into a recession, that does not mean that suddenly inflation is going to go down and therefore break even should decline a whole lot. Money supply growth had been negative for a while, but recently in last 6 months or plus has been positive. It's low, but money velocity is still rising. It's almost back to where it was at the end of 2019. So we care about the amount of money, the growth in the amount of money. We care about how fast it moves, and that's velocity. And for a while, I've been using the imagery of the trailer connected by a spring to a car speeding away. That's what happened at the beginning of COVID, is that that spring, that stretching of the spring, was the reason that velocity plunged, is that you had this sudden increase in money, and which is the car speeding away, and the actual economy itself doesn't come along. Prices don't adjust quite as fast. Well, now we've gotten to the point where the trailer is almost fully caught up to the car. Velocity is almost back to where it was in 2019 before COVID. Now, there are reasons to think that velocity should now be higher than it was in 2019. But the important system is that the monetary system, forgetting about all the micro stuff, the macro stuff, money and velocity, has been trending back towards some kind of equilibrium. The increases in velocity, the rebound, has been slowing quarter after quarter. Money, which had surged and then was negative, is now kind of creeping back to a low positive level. And in general, that system has looked like it's getting closer to sort of some equilibrium, even though obviously that equilibrium shifts over time. It shifts over time in normal circumstances slowly, and so that's okay. The volatility in the entire money system should decline as everything gets back to the original equilibrium. That's sort of my point. Except, and here's sort of the bigger point, we're about to get about to start a new easing regime. And the Fed has more or less indicated, Powell has not said this directly, but it's been, the various people who represent the leaks from the Fed have basically said we're going to get an ease in September. Some brokers, some of the big banks are calling for 50 basis points in September and another 50 basis points after that this year. I don't think the Fed will be that aggressive, but if the stock market continues to sell off, they probably will. If we could settle money growth in the 3 or 4% range, then I'd feel pretty good about where we are inflation-wise and that we're going to settle back to this nice tame inflation environment. Even though velocity, the continued rise in velocity would probably add to inflation being a little bit above 2% for a while, but it wouldn't be egregious, right? We'd be going back to this more stable monetary growth and, to the extent the Fed is not like really aggressively doing something, we could sort of get back to normal. But we're about to start the Fed aggressively doing something. If it's just with interest rates, if they don't actually expand the balance sheet again, then then we could get a decent outcome, probably more volatility, but we could get a decent outcome. If they also turn around and expand the balance sheet again, and I'll be watching for that. And if they do, then equilibrium money growth isn't going to be 3 or 4%. It's going to go back to the old 5 or 8%. And it may anyway, by the way. We might just get money growth to 5 to 8%, might just be sort of where it had been for 25 years before COVID, might be where it settles back to. And if it does, even though the volatility in the whole system will go down, that amount of money growth in this environment is too high, and we'll end up settling into the high 3s, low 4s on median inflation, not just for 2024 and 2025, but for the longer term. My call for a while has been high 3s, low 4s, and that's where we'll settle in. And the only question in my mind is that 2024, 2025, or is that really where we're going to be for a long time? What the Fed does here as the economy weakens again, but in sort of a normal way, not because of COVID, what the Fed does now could well affect where we end up. And we're going to end up a little bit above 2 in the long run, I think. But whether we end up in the high 3s, low 4s will depend a lot on what the Fed does over the next year, really. Anyway, that's my expectation. It has been for a while. Things can change. Stay tuned. I have a few other topics that I wanted to get to that I sort of planned to talk to today before the stock market sold off. And I'm not going to get to them today, but over the next few podcasts, we should talk about tariffs. Domestic U.S. policy is shifting that way, with one political party heavily in favor of tariffs, and the other party, recognizing that it's a winner among the working class, is speaking more agreeably about them. So the tariff situation, the amount of commerce and the amount of imports and exports that are going to be subjected to tariffs is changing, and so we should talk about what that means for inflation. And so what's the truth about tariffs and inflation? And we'll cover that in the next couple of podcasts at some point. I also need to talk about Japan. I mentioned today they had a big sell-off in the Nikkei. There was a New York Times article in late July saying that Japan welcomed inflation as a way to shake out of a sluggish economy. It's not going as planned. Japan is so misunderstood when it comes to inflation, and it's in bad shape in an awful lot of ways, and it's worth talking about. And so we'll talk about that sometime in the next couple of pods. But for today, I mainly wanted to address the recent market declines, the unemployment increase, and so on. And the important takeaways are, A, the stock market is not the economy, and B, the market is not declining because of the unemployment rate or the Iran-Israel fight or because the Fed is behind the curve. Those are excuses for triggers, and you have to recognize that the market had been declining before any of those stories from last week. The why is risk reduction. And while we'll get some market bounce, I'm sure, because we always get market bounces after this kind of sell-off, I'm sure that the need for risk reduction over the next couple of months is real. And so I sort of think that we're going to have kind of some continued pressure on prices here for a little while. None of that should affect what you think about inflation in the long run. 10-year TIPS real yields are 1.75% plus inflation. That's lower than they have been. They've been in the kind of 2.25 range for a while. 2% is kind of the long run fare for real yields. So 1.75 is a little rich in kind of an absolute sense, but they're higher than they should be given where nominal yields are. So if you're investing in fixed income, you probably should be tilting more towards TIPS at this point. Take advantage of the people who think that we're about to slide into deflation, because after all, what that helps you do is defend your money. That's all for today's podcast. Please like, subscribe, send others to this podcast. You can write to me at inflationguy@enduringinvestments.com, and you can find the blog at inflationguy.blog. Follow me on X at inflation_guy. Visit Enduring Investments if you need help with diagnosing and treating an inflation problem. And most importantly, as I said, defend your money. And if inflation is coming for you, remember, you know a guy.